Hi there, everyone. Welcome to this latest webinar from the Financial Suitability Forum, What PROD Means for You. That's the Product Governance Rules. My name's Craig Saunders. I'm going to be your host for the webinar today, and I'm joined by the Financial Suitability Forum's convener, Paul Resnick. Paul, welcome.
Thank you, Craig. How are you doing?
I'm very well. Now, PROD is one of those things where people know about it, but they don't necessarily understand what it means for them. This is actually a bigger deal than some people would think.
It seems to be a very fundamental change to, you could almost say, a fundamental change to capitalism. There was always the notion of that the customer had to be conscious and aware of the risks they were taking on individually. It was often called buyer beware. And governments for the last 60 or 70 years have tried to rebalance that by putting obligations on the manufacturers and distributors of products so that the individual, the buyer, the customer was protected. That, I think, largely saw failure or was viewed as a failure around the 2008 crash. And what we're now seeing is the fundamental recognition that it's not just the liability of the end customer or the responsibility of the end customer to protect themselves, but that it is beyond simple transparency, which has been the primary mechanism to try and even the relationship. We're now seeing liabilities being sheeted home specifically to the manufacturers of products in financial services. So it is an extraordinary change. It is really a tipping point.
So it brings us to this slide that I've just put on screen now, that there's a change in the relationship. What you're describing is it used to be buyer beware, and now it's become seller beware. The person selling the advice or selling the product has to be particularly cautious now. It's akin, if you like, to a car salesman being told, if you sell a 500 horsepower Ferrari to somebody on their learner's license and they crash it, we're going to hold you liable for that because you should have been able to see that this was not right for them.
And it's clearly taken a long time to come, and we can see in several regulatory environments that there's a very strong reaction against that shift. It works out, as has happened quite consistently over the last 10 years, that the UK's interpretation, or the UK regulators' interpretation of the MiFID rules themselves is much more consumerist than in any other country. And so we see in PROD the latest articulation of that shift. And it is very clear. It is the pendulum is swinging quite solidly towards giving sellers liability for the manufacture and distribution of product, not just advisors.
And what we're seeing, I think, is an admission that the regulatory systems that we've all known for the last 25, 30 years were a failure. And they were based on the assumption that if you disclosed enough information to people, they could make sensible, informed decisions. I think what the regulators are acknowledging now is that it doesn't matter how much you disclose about financial stuff to a lot of people, because they're just not going to grasp it, because the mountain to climb is too high. They're not going to be masters of those domains that quickly. And so they're putting the onus back on the people selling the product to say, look, you have to understand that disclosure is not getting us there, and that's why we're making you liable. But PROD doesn't exist on its own, of course. Now you've got PROD coming in at the same time as the senior managers and certification regimes. And so what it's saying is, we're going to hold you liable, and here's a big nasty set of penalties that we're going to weigh about you if you get it wrong.
And it's certainly a fundamental shift. We've had a very long period of time where disclosure and transparency was viewed as enough. I've worked long enough in that area to know that I can spend hundreds of pages explaining something without any any expectation that the client will actually realize what that is. So in the work I've been undertaking with Phenometrica over the last 20 years, we've tried assiduously to show the lists of risks have no meaning. It is the consequence of risks that's the critical issue, and that's the difficulty. There's been a presumption of literacy and numeracy, which the data and the research consistently shows doesn't exist. So we've had to move to a new and higher level of responsibility.
So let's start getting into PROD now. I'm just going to share the screen here, which says that PROD is about targeting. And this, I think, is the core of it, that firms must ensure that their products meet the needs of one or more identifiable target markets. So you can't be making this up post-event. You can't meet somebody and then say, oh, you'd be right for this. You have to be defining those target markets in advance. You have to define the converse, unsuitable target markets where sales might be restricted. You have to ensure that they're only sold to clients in the target markets by the appropriate channels, and that we get appropriate client outcomes. And the most critical thing is this is not just a rule that applies to product issuers or product manufacturers. It flows down the line with responsibilities falling on the shoulders of advisors as well.
So what we've actually done is we've changed the relationship. And if we think of it graphically, it used to be that the advisor was in the crosshairs and had the highest level of liability. The advisor was, in fact, the only one who had a fiduciary responsibility in the relationship with clients. The product manufacturers were largely left to do just that, manufacture and wholesale effectively to the advisor, who took on full responsibility, both morally, legally, for the relationship with the client. That's no longer the case. It's no longer sequential liability, it's a parallel liability. And suddenly the manufacturers of products are liable, and the senior executives of those firms are liable as well, to make sure that there is an appropriate matching and appropriate suitability of product to clients' needs.
Australia has some pending legislation that, due to the election happening there, probably won't get up prior to that, but looks like it will inevitably come, that's loosely modelled on the UK PROD rules. And when it was released for circulation in Australia, the leading law firms put up their hands and said, you do realise, don't you, that this is putting the liability back on product issuers, which we haven't had for 30 years. And I think people in the government just nodded quietly and said, well, that's kind of the point, guys.
It's taken a long time coming. The advisors have been largely liable, despite the very poor training they've often been given. And I've found over the years, when I look at the influence of product manufacturers in the training of advisors, you can almost see it's in their best interest to limit critical capacity or the development of critical skills in advisors when it comes to understanding investment and investment consequences, the consequences of high turnover of stocks in a portfolio, the consequences of taxes. Much of it has been well hidden, and it's really required a great deal of individual assiduousness on behalf of advisors to dig themselves out and understand what's propaganda, what's marketing, and what's actually education. And I think this shift is a shift in the regulation, is a clear mark that didn't work, it couldn't work, and we're now building up significant momentum to improve outcomes for advisors and their clients.
Well, let me just take us back to our slides now, and we'll start to get into the details of what's in these PROD rules. The first set of responsibilities are for the product issuers. Now, a manufacturer or an issuer of a financial product has to ensure that it's designed to meet the needs of an identified target market of end clients, has to ensure that the distribution is compatible with that identified target market, and has to take reasonable steps to ensure that it actually does end up in the hands of that target market. If I'm a product issuer, Paul, how do I deal with all that?
Well, the liability is there. What's intriguing as you look at that, this reads like a very sensible form of marketing and strategic planning, doesn't it? It says that you do best when you actually know what you're doing. And over the years, we've had many a conversation at conferences and workshops when we're talking about the best businesses. They are the ones that are very clear about who they work with and who they don't want to work with. And in essence, what we have here is a parallel. The regulator is saying do the same thing. You'll get the best outcomes if we literally apply the word suitable in its common English expression. Make sure that you know what your product and service, who it is suitable for, who it best meets, and don't waste your time with those it doesn't match. So it is, once again, a high level of face validity. When you look at the wording here, it says you'll get the greatest persistency. Clients will stay invested longer. We all know that the greatest impediment to profitability, both of the planning business and the product manufacturer, is turnover of the portfolio, of people leaving, taking their money out, shifting because they were surprised by the outcomes, the volatility, or they're chasing higher returns because the market's booming and they've missed out. All of that is almost literally identified in the obligations of PROD.
But to call a spade a shovel that's going to hit you in the back of the head, a lot of product issuers in the past haven't necessarily cared about any of those things you've just talked about. A sale is a sale is a sale that goes into this year's bonus, and if it blows up next year, that's somebody else's problem. And
that's been the unfortunate part, particularly a challenge in Australia, where we both come from, where it's been very clear that the key performance indicators for senior managers are rewarded enormously by share price strength, and that's enhanced by short-term sales process. The end result, in the Australian case, for those of our listeners may not be aware, we finally got to a royal commission to look at the mis-selling of investment products, mainly through our vertically integrated banks. And the consequences have been quite devastating. Up till now, there's over $6 billion of compensation. A number of CEOs and chairmen have been forced to resign. Share prices have been diminished significantly, and we have a large number of class actions as well as criminal actions underway from the regulator. So it's in a sense the eagles have come home to roost, you might say, in Australia after many years of not caring about the outcomes for investors. The punishment is being applied as we speak.
Well, in the UK, in the PROD rules, the target market determination speaks that products must meet the identified needs, characteristics and objectives of the target market. And let's call the target market a client for a moment, because that makes it a bit easier to understand, including a risk-reward profile that's consistent with the client or the target market. What we're seeing here is a mirroring on the product side of the suitability rules that exist on the advice side. What are the needs? What are the characteristics? What are the goals? What's the risk-reward profile?
And that goes back to the ones we've been, that those of our listeners and viewers will be familiar with. Know the client, know the product, show how it matches, how the product matches the needs of the client, But the critical part that we add to that equation is getting the client's informed consent. Now, recognizing, as we said earlier, that clients typically are neither particularly numerate, literate, or financially aware, informed consent is a very high standard. Advisors have an opportunity created by that to help coach them and help them make those informed decisions. That's the critical role that advisors have, because the trade-offs between what a client wants to do and what the client can afford both emotionally and financially to do are often unclear until drawn out by the advisor, and are not necessarily simple. I need to take more risk, but I'm terrified of the consequences, and if it all goes wrong, I'm buggered. And very difficult.
For people who aren't familiar with informed consent, it's a principle that comes from medicine, where if a doctor's treating you today, they will say to you, Paul, here are all the options that you have in your current circumstance. Here is why I would recommend one option over the other. Here are the risks of the option that I'm recommending to you. Lay all that out for you and make you understand it so that you can say, yes, go ahead with the operation. If you don't say go ahead with the operation, it simply doesn't happen. So that's what you're talking about in a financial advice context, that somebody would say, well, here are the different options that we had available. Here's why I chose one over the other. Here's the best and worst that can happen on what I'm recommending to you. But ultimately, you are the person who's responsible for your own destiny, and the choice is yours.
And quite different, isn't it, from being sold a product? It's quite a different philosophical, social interaction. It's collaborative rather than paternalistic, in a sense, if one looked for a very simple distinction. It's not the advisor telling the client what is the best course of action. It's the advisor illustrating the alternatives and the consequences and encouraging the client to take ownership of the decision.
Now, meanwhile, the poor old product issuer, they're bearing their soul like they never have before. They've got to do a scenario analysis that can assess just how bad their product could go. Under the worst market conditions, what could it be? And then tell people about that. So they have to test for market deteriorations, the financial failure of a counterparty, what happens if a product fails to reach viability. For example, if it needs to be at £25 million or dollars to work and it only gets to 10, what happens then? Does it fall over? Does it keep going? Does it just limp along? What happens if on the other side of demand's much higher than expected and they're flooded in money and they can't get it placed? All of these are real problems, but they're not really problems that people are accustomed to discussing in public.
Never before. You just look at that list and you see that what it does is it encourages a high level of concern and even conservatism. If you take on the responsibility of being a manufacturer out into the marketplace and you are a senior manager in the firm promoting that product, you have to be very clear not only that how you articulate what those risks are, but you actually provide examples of what it looks like. And traditionally that's called scenario testing, and being able to say, well, this is what it might mean. Now, one of the things we are conscious of is that in the accumulation mode, several of the risks associated with a new product can be fixed by time. When we're in the decumulation mode, we run, as many of our listeners know, we run a sequence risk issue. And if a proportion of the portfolio is inaccessible or underperforming, it is the other parts of the portfolio, the remaining components, which have to take the weight in a drawdown, in a withdrawal by the client. So what we see in those obligations is a very clear responsibility, particularly in retirement, in the stage where clients are going to be using the capital to meet their living needs, that advisors and the manufacturers must tread very, very cautiously.
And there's one more element of responsibilities that falls on the product issuers, and that's that they have to do reviews of everything we've just been talking about. So they have to review on a fairly regular basis, depending on the complexity of the product is what drives the regularity, whether the financial instrument is still consistent with the needs, characteristics and objectives of the target market, whether the intended distribution strategy is still appropriate, whether the instrument is being distributed to the right people, and whether it's reaching the end people for whom it was originally designed. Now, all of these are new responsibilities and new accountabilities, which must mean new expense and new people for just about every product issuer out there, but also new systems. Their systems weren't built to do this sort of thing.
No, because the last 30 and 40 years has seen the development and the separation of manufacturing from distribution. And there were no records kept. It is only the vertically integrated businesses that have any notion of of which advisors and which clients are recipients of advice and holding the various asset classes in their portfolio. None of that has been available to the manufacturers. So the demands to do this are quite original. It is not since 30 or 40 years ago, when we had very simple products being sold by tied agents, could we approach being able to provide the data demanded by the regulation. All of a sudden now the manufacturer has the same suitability obligations as the advisor, but probably with a strength, with a greater need for rigor, because they've got to do it in advance. They can't just wait for the client and do suitability. They actually have to research the market and understand those clients' needs and circumstances.
And then they also have to share with the advisors, and this is where we'll kick across into distributors. They have to share with the distributors, which are basically financial advisors and people like them, any information about the product, the approval process that it's gone through, what the target market is, how that market was determined and assessed, the appropriate distribution channels for that product, and all of this information is to enable the advisors to understand and properly recommend to sell the product. It's not intended to be passed on to the client. And that gives us the big clue that there's responsibilities here on the advisor's shoulders. So let's kick straight through to what they are. They must understand the financial products that they're distributing to clients, which sounds a bit like Captain Obvious, but in the past, you couldn't always say that people did understand a product to the level required by these regulations. They might have understood the top 2 or 3 lines, but not what was driving it way down underneath. They have to be able to assess the compatibility of the product with the needs of the client and assure it's only distributed when it's in the best interests of the client. Again, this is mirroring the suitability, but it sort of has a nasty snarl to it.
It's certainly very rigorous, isn't it? When you look at that, you're really saying we've got to be able to do suitability with great care and we are being given a significant amount of information if we're an advisor about what is in the head and what was in the intention of the product manufacturer. Once again, this has not occurred in any other jurisdiction other than the UK, and I can feel or can find nothing of any parallel development in Europe, where of course the MiFID regulations started. So it is uniquely UK, with Australia following a long way second and the third are still still having afternoon tea while the others proceed to the finish line.
Now, interestingly, even though the product manufacturer has defined a target market for the product, the advisor is obligated to do their own target market formulation. They have to work out who in their client base is going to be offered which products. And this is potentially where one of the big trip-up points is going to come, because there seems to be a bit of thought kicking around town that one day this is what the FCA is going to knock on the door and ask to see. They're going to look at your file and say, where have you mapped this? Where have you gone? Well, this product will be suitable for Joe and Fred and Mary, but not for Tom, Dick and Harry.
Well, and I think what this brings us to is the trend that is very visible over the last 5 years of simplification of products, and the growth in the use of constructed portfolios, DFMs as they're often called, discretionary fund manager, multi-asset solutions, because they de-risk for advisors the liability that sits here. It's pretty difficult to be able to sit as an advisor and say, look, we have the competency proven in-house over the last 10 years to construct portfolios. We have the details of the benchmarks we had established and agreed with clients, and our ability to deliver against those benchmarks. I think for many advisory firms, the systems weren't in place. By outsourcing to a DFM and staying close to the financial planning, the suitability process, because in essence they're one and the same. Suitability and financial planning are just different words for the same issue of helping people meet their goals and aspirations in a timely manner. But this stuff is really very, very, very rigorous demands.
Now, I did mention that it wasn't necessarily suitable for Tom, Dick or Harry. This is actually an important part of the rules. Advisors have to have defined negative target markets. That is, these are the people that we wouldn't be selling this product to. But that said, you can still sell that product to those people if you have jolly good reason for it. And that's one of the little confusing aspects of these rules, that they don't actually bar things from happening, but what they do is put up a fairly high barrier that you have to get over in order for them to happen. So, for example, here, if you were selling a product to a negative target market for that product, you would want to have every T crossed, every I dotted, and every piece of paper ready for the regulators when they came to look at it.
I think that's right. There's a reversal here going on, isn't there? That there is an expectation that you understand the target market, you understand your product, and that there should be a very straightforward alignment. When you do something different, there has to be a very good reason for that. So in practical terms, it's going to drive advisors to be more conservative in their recommendations.
Now, the other big thing is that there's a fair whack of red tape comes along with this for both advisors and issuers. They're both required to review all this on a regular basis and report all this on a regular basis. For example, product issuers have to actually report to the FCA what percentage of their product is being sold to out-of-category markets. So there's an administrative burden that goes along with this, and also a bearing of the innards of an operation that hasn't necessarily happened before.
Yeah, high levels of transparency of data that may not exist. I've heard several stories of fund managers, manufacturers seeking the data from intermediary processes like Phenometrica, for instance, and we of course have these immediate dilemmas that this is entirely inconsistent with our relationships with our end customers. We have no contractual, moral or ethical way of being able to deliver that data without the consent of advisors. And I'm fairly certain that many advisors would find it very difficult to concur that or to agree for the data to actually be passed on to the manufacturers of products. So we have some really interesting tensions emerging in around the getting the data in the first place and then making it available to various parties. So lots of law to be tested and lots of relationships to be put under pressure for this to work through for the bit, so that the reporting can be delivered on time.
What's your sense of where people are up to? Do product issuers particularly have this covered, or are they still scrambling to get it covered?
This is scrambling territory. I think what we're seeing in the UK, the growing dominance of vertically integrated businesses makes this much easier. But if you're an independent advisor using a broad range of both multi-asset and individual asset class funds, you're going to be very much very unlikely to agree for that data to be passed across. So while the trend is for a growing proportion of new money to be in the simple world, there's an awful lot of old money that's sitting on platforms or sitting on old retail products where none of this reporting will be possible. So scramble is a good word. Fiction might be another.
So what needs to happen at the advisory level for people to prepare for this? What sort of changes are they going to be putting into place?
Well, I think the argument towards understanding and agreeing relationships. So the gap between product manufacturers and distributors, between advisors and fund managers, actually has to get closer. The regulation is saying that you have a symbiotic relationship, at least through reporting, and definitively through suitability in outcomes for clients. You better be talking much more regularly and with much more meaning. If I'm looking to maximize my business, I've always wanted to have a good ongoing relationship with that I'm well rewarded for, that the client believes what he or she pays is less than the value they receive.
And I guess
it's got to be a value, and that takes us into financial planning, which is the point I wanted to make. You cannot just transact and survive.
And I guess the other consequence for advisors is if every product is a major commitment, you're going to deal in fewer products.
Yeah. And what we're going to see is if it's not vertically integrated, it's going to be a much tighter list of products that advisors work with. It's just, it's common sense that will drive it that way, even though the obligation, if you're an independent advisor, is to be constantly reviewing what's available in the marketplace and using what you've learnt about the marketplace to give suitable recommendations to clients who are different from the others that you give your core consistent portfolio recommendations.
I think that's a good place to wrap up today's webinar. Paul, thanks for being with us.
Thank you, Craig.
And folks, thank you for your company. Please do remember that on the Financial Suitability Forum, you'll find more webinars like this. There's podcasts, there's blogs, there's news about suitability, there's regulations. It is your one-stop shop for suitability today. So please do take your time to check it out, and we'll see you for another webinar soon. Goodbye for now.